Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest instalment of our Through the Noise mini-series to discuss our Q2 outlook, Staying Safe. Today I want to talk in a little bit more detail about our equity market outlook. We've been underweight equities through the year as we get more and more concerned about the risk of a recession in the US and Europe. To explore the implications of this for global equity markets, I have with me Daniel Lam, our Global Head of Equity Strategy in the CIO office. So Daniel, we continue to be underweight global equities. What are the key reasons for our underweight? And what is new now compared to the publication of the annual outlook a few months ago?
Thanks, Steve. The key argument against equities is still about recession. Now, compared to a few months ago, we see a high probability of recession in the US, now at 80%. And it is important to remind ourselves that equities are unlikely to bottom out until the recession begins. Now, the most important development over the last few months is, of course, the issues surrounding the financial sectors in the US and also in Europe. This complicates the Fed and the ECB's fight against inflation, which may lead to tighter lending standards, slowing growth, weakening consumption patterns, and downside risk to earnings estimates on a 12-month horizon. Now, we understand that markets are seeing 75 bips of rate cuts in the second half of this year. But this mix of slowdown in growth and falling rates, we believe, bodes well for fixed income to outperform equities in such an environment. So we believe that it is too early to turn more favorable on equities at this stage, despite this potential Fed pivot.
Okay, so earlier in the week we spoke to Rajat in terms of the different stage of the economic cycle we're seeing in Asia, in particular China. So what are the prospects for Asian equity markets?
Well, the picture is different there, and it's brighter. So Asia ex-Japan remains our preferred region within equities. The main driving force is the improving narrative for Chinese equities, which is more than 40% in the MSCI Asia ex-Japan Equities Index. So China's economic recovery is likely to support and improve earnings growth profile. A potential deceleration in Fed rate hikes and a weaker US dollar may need to fund inflow. Now, within the region, we are overweight Chinese equities. The National People Congress held in early March stressed upon high-quality growth and economic stability. So following China's reopening, the outline of business-friendly policies and property sector stimulus further help investor sentiment and private investments, so boosting earnings growth expectations in China and across the region. And if you look at China's valuation, it remains attractive and is currently trading at a 19% discount in PE to Asia ex-Japan equities, and that's below its long-term average at 8% discount. The country's expected earnings growth in 2023 has also been revised higher to 17% compared to 15% at the start of the year.
Okay, so what are your views on US equities?
All right, so we are neutral US equities because it is relatively expensive in terms of valuation, and there is risk of further earnings downgrade. So if you look at US economy, consumption has been the main support. So the consumers, they have largely maintained their spending habits on the assumption that the labor market was strong and they can easily find employment if they lose their job. But those assumptions are likely to change now because the banks may be retreating further from lending and lending standards are beginning to tighten. Also, if you look at what the US government needs to do, they need to restore confidence. They need to show to consumers and small businesses that their deposits are safe. So if you look at the small business surveys, they have already been under pressure since 2021, in fact, because the smaller businesses are facing the brunt of surging input and financing cost, and also increasingly tight labor markets, which basically put pressure on margins. So this may start to affect credit spreads. Now, the saving grace for US equities is the potential Fed pivot that we had mentioned before. So this would help the valuation of growth stocks, which are bellwether and key to US equities.
Okay, so what about elsewhere in the world? What are your thoughts there?
Okay, so first of all, we're staying neutral on Euro area equities. There is significant valuation discount, particularly versus US equities, but that's offset by the aggressive ECB rate hikes. Japan is neutral. We actually upgraded that from a underweight. So the key plus factor is the reopening in both Japan and China, which eases supply chain disruption. Valuation continues to be attractive both on an absolute and relative basis. But on the other hand, a potentially tightening BOJ may lead to strengthening Japanese yen, which may in turn hurt earnings. And finally, we downgraded UK equities to an underweight. We know that UK equities are cheap in valuation and they have high dividends. But UK equities are heavy on the value sectors. So MSCI UK, for example, has roughly 40% weighting in sectors such as energy, materials, and financials combined. But these sectors only make up about 25% in MSCI All Country World. Now, slowing growth is leading to moderation in both inflation and oil prices, and this may hurt the performance of value sectors.
Okay, thank you very much, Daniel, for your insights. That's all we have time for today. While it certainly seems to be a challenging environment for equity markets overall, there are some pockets of opportunities out there in the asset class. Thank you, listeners, for joining us. I hope you found it useful as you continue on your investment journey. Should you need more information, please do not hesitate to take a look at our Standard Chartered Wealth Insights page on either LinkedIn or Facebook. I will be back tomorrow with Manpreet to talk about the currency market outlook, and I look forward to talking to you then. Goodbye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.